Here is the main problem why many day traders fail to trade efficiently using moving average. It's the false breakouts or whip shapes that occur when price moves back and force crossing the line you apply on your chart. You know the drill. As the price moves above the moving average, that's a buy signal. As the price moves below, that's the sell signals. But the market isn't perfect. You get one signal to move across the moving average, followed shortly by an opposite signals. These false signals almost always result in the small loss. Small loss. The same problems happens when you apply the crossover system, so for scalping or day trading. Moving average crossovers will work when the market trend to substantial period of time. That is when the moving average you see on your chart look all nice and pretty. Only problem is that those nice and clean trends don't always happen when the ranging markets come and the false breakouts start to happen. The moving average trades trend to start taking losses as the market trend to reverse once the moving average trigger the entry. So how to reduce the false signals, because we can completely remove them. The problem is that when we apply a moving average study, we focus on the line that appears on our chart, which is plotted based on the closing price, and that's a very small margin. Instead of plotting the moving average based on the closing price, I use the moving average channel. Here's how it works. We have two moving average forming the channels which are applied to the bars high and the low to listed of the bars close prices. So instead of moving average, you will have two moving average on the chart. Instead of focusing on just one line, you will have an area. This moving average channel will filter a lot of all signals and will save you a lot of losing trades and lots of money. The moving average HILO channel tries to find trending markets and is extremely useful for staying out of sideways markets. The channel turns a simple moving average into a zone of support and resistance in the market. With a strong trend, price may trend easier above or below the channel. Some trades prefer to buy or sell breakouts above or below the moving average. High-low channels other trend tend to use resistance and support areas as zones to establish market positions in the directions of the main market trends. Remember that moving average leads and responds to the price. This is why you must analyze it together with the price actions, and my favorite way to trade price actions is by using Heiken Ashi bars. When using Heiken Ashi, you can treat it the same way as you would traditional candlesticks chart. The difference is that price have been smoothed out to the perfect directional base. As with candlesticks, you might use chart patterns with the Heiken Ashi, but your view might be better informed by constantly in the color conditions, which may indicate reversal bars more clearly and sometimes more accurately. So by using the moving average channel and Heiken Ashi combinations, we plan to remove the noise and false signals and to catch longer and resistance trend detections is one of the main functions of this strategy, because both Heiken Ashi and the moving average channels put an emphasis on the resistance trends. Small corrections and consolidations are left behind, and they are very visible on the chart. You will notice that when the directions change on the Heiken Ashi gaps, the price most likely starts on your move. This helps to distinguish between the potential beginning and the end of the trending move. With the Heiken Ashi chart, you can distinguish a strong trend from weak price actions at first glance, but bullish Heiken Ashi trends looks like the normal Japanese candlestick trends. However, you will notice that the Heiken Ashi trend is built primarily by the bullish candles and is absent of the lower candlesticks. When the price is chopping up, the price actions creates very little to no lower shadows. The bearish Heiken Ashi trends has the same functions as the bullish one, but in the opposite directions. This means that is built mainly by the bearish candlesticks. Also, a strong bearish trend on the Heikin Nations gaps has very little to no upper candle shadows. Here we are using the 50 period low channel on the high canals chart. However, you can explain with the different look back periods to see which one works best for you. Higher settings tend to work well for the obsession trends, and the lower look back periods are good for the timing. First aspects we need to do is to determine the market's directions. The primary function of this day trading strategy is smooth trends. When the channel is pointing up, we have a bull trend. When the channel is pointing down, we have the bear trend. By the way, I use this indicator on the Tradingview. When moving average channels is chopping upwards, the lines are green. When it's looping downwards, the channel is red, and then the moving average are flat. The channel is gray, but the market aren't always the simple to analyze to make sure that you are not trapped. The end of the trend, we need to examine price actions using Heiken Ashi. When the higher candlestick price structures aligns with the moving average channel, the market is trending. When they opposite each other, the market is slowing down and might be reversing or retracing. For the uptrend, the price is above the moving average channels. The channel is green, and the Heiken and Ashi candles are green for the downtrend. The price is below the moving average channels. The channel is red, and Heikin Ashi candles are red. The range of channels is related to the look back period. Fast moving average responds quickly to the new price data and could form a step light, but slow moving average are weighted down and shown more stable slopes when the price is inside the channel. I avoid opening any positions. This is the no man lands, a period of decisions where you want to clear breakout any inside of the channels. I also avoid opening positions when the slope of the channeling change from the upwards to downwards. The flat is very short period of time. When this happens, you can see the price breaks the channels in both directions. The market consolidates, so there is no clear trend on the market. You must also analyze the distance between the moving average channel and the high candles in the sideways market price targets with the moving average. There is a little no gaps between the price and the moving average channels. In the healthy bull trend, the price stays the fair distance above the moving average channels and stays below the vertence. In the overextend trend, you will find the striking distance between the Heikin Ashi candles and the moving average channels. So the strategy is very simple and very efficient. At the same time, a breakout above the moving average channels with the green Heiken Ashi candles signals buying pressure. Breakout below the moving average channels with the red Heiken Ashi candles signals selling pressure. Pay attention to the slope of the channels, the distance between candles and the channels. You will eliminate a lot of the whole signals depending on your level of experience. You can add other filters to find the best setups. Here's the great one, the ADX indicator. The average directional index will confirm if the market is ranging or the new trend is likely to take place. ADX is plotted as the signal lined with the values ranging from 0 to 100. ADX is non-directional and resistance trends where price is trending up or down. ADX value will help you to identify the strong and the most profitable signals. I personally ignore all signals in the ADX lines is below 20. ADX the reading above 20 suggests that the trend is strong enough for the trend trading strategies. Low ADX is usually a sign of the actual accumulation distributions. When the ADX below 20 for more than 20 or 30 bars, you will see the price at range conditions. So ignore the signals that we find because they will have a low probability of working out. When the ADX is below 20, price will usually move up and down between the resistance and the support to find selling and buying interest. When the ADX line is rising trend is increasing, the price moves in the directions of the trend. When the line is falling trend is decreasing and the price enters the period of retracement or consolidations. Here have several examples with the ADX filters. Another filter is the regular directions. I'm a big fan of the combining learning with the lagging signals to confirm my trends. One of the most powerful trading signals that combines price actions always with use of indicators is divergent signals. Regular divergence is used to forecast an upcoming price reversal. When you spot the regular bullish divergence, you expect the price to cancel its bearish move and to switch to an upward move. When you see the regular bearish divergence, you expect the price is cancel its bullish move and switch to a downward move. Divergence trading is the extremely efficient way to confirm our strategy. The reason for this is because divergence formations are leading signals. This means that the divergence patterns is likely to occur before the actual move is. We are able to anticipate and enter the trade using our strategy at the beginning of the new emerging move. Here's the several examples with the MACD histogram divergence is filter. So being a day trading and scalping strategy, you would use any time frames between 1 minute and 50 minutes, and when it comes to select the markets for the using this strategy, it's vital to pick one of that is volatile, so that you are more likely to see high number of the moves. As always, if you learned something new and found value, give us a like to show support, subscribe to our channel and click the bell icon to stay notified every time we upload new video. Until next time.